This episode is the most important episode in the foundation section of this course. Break of structure plus fair value gap is the entry model across all my strategies. The Dark Knight uses it, the Liquidity Sweep uses it, the channels use it. I also use the IFVG, inverse fair value gap. But primarily, the break of structure is much more forgiving and gives a better risk to reward trade. By the end of this episode, you'll know exactly what triggers an entry and what doesn't. What is a break of structure? A break of structure is when price takes out a prior significant high or low with conviction. In a downtrend, price places a low and then pulls back and creates a swing high. When price moves back to the downside from that swing high and breaks below the previous swing low, that's a break of structure. Let's have a look at that quickly. So right here we have a high, we have a low, we have a high, and then we break back down past this low and put in another low, right? This point here is what we call a break of structure. And if you have a look at this, I'll zoom in, you're going to see it's the low. We draw the line across, and this candle here breaks below that previous low. That is a break of structure. The bullish version is exactly the same, but in reverse. Price places a swing high, pulls back from that high, creating a swing low. When price moves back to the upside and moves through the previous swing high, that's bullish break of structure. The word conviction matters. The candle must close beyond the level, not a wick, a strong high volume candle. So conviction, right? We've got to break structure with conviction. This candle just pushes straight through, high volume. This particular one creates a fair value gap, and we use that later on as an entry point. There's another example down here. Here's a break of structure, right? Price pulls up, it pulls back down. Pulls up, pulls back down. That is our volume candle. It creates a fair value gap. We draw it out. That gets tested twice, if not 3 times, and then that trade opens up to the downside. This is a clean break of structure. The candle closes convincingly beyond the swing low. Nice, clean, high volume candle. What is a fair value gap? A fair value gap is an imbalance in price, a range where buyers and sellers never traded with each other because price moved too fast. It's a 3-candle setup where the wick low of one candle in a bearish setting prints. Candle 2 is a high volume candle which creates the gap, and candle 3's top wick does not close the gap left between 1 and 3. So we'll see here, we've gone through this previously, right? The fair value gap is a 3-candle setup. We've got candle 1, we have candle 2, and candle 3. Candle 1's bottom wick closes here. This puts in a large volume move, creating a gap. Candle 3's wick comes all the way up to here, but it leaves a gap between the top of this wick and the bottom of the candle 1's wick. That is what a fair value gap looks like. It's a 3-candle pattern. Candle 1 opens and closes. Candle 2 moves aggressively, a big impulsive move. And candle 3 doesn't close the gap left between 1 and 3. Right? If this wick comes all the way up, then that is not a valid entry. There needs to be a gap between this wick and this wick. Candle 1 and 3 creates the gap. The fair value gap is the space between candle 1's low and candle 3's high. Price moved quickly through that area with high volume. Right here. High volume through. Candle 3's wick does not come up and close that gap. Why does price return to fill it? The gap represents a gap in order flow. One-way orders, in this case sell orders, price will return to fill the gap of one-way orders in that zone. It rebalances the order books. This is the mechanics. Now let me show you the complete entry sequence. Here's the complete break of structure plus fair value gap sequence on a real NQ example. Step 1, do we have a valid channel? We certainly do. We've got highs, lows, lower highs, lower lows. Step 2, do we have a break of structure into a fair value gap? Yes, we do. We've got our break of structure through here, and we have a break into a fair value gap. Step 3, mark out the fair value gap. Let's just get rid of this and we'll do this. There we go. The fair value gap is from candle 1 and candle 3. Creates a beautiful fair value gap. Step 4, wait for price to recycle back into the fair value gap. Right, prices come down and it's recycling back up into that area, which also happens to be on the discount of that channel. Entry at the 50% or the 25% level of the fair value gap. So here we go. We'll just put the Fibonacci on there. And you can see we have a 25% entry and we also have a 50% entry. So it's entirely up to you which one you feel comfortable taking. We're taking the 50% entry on this example. Our stop goes at the high of the candle that created that fair value gap, and we are targeting the premium of this particular channel. And as you can see, this runs down for a 1 to 15.9. That is risking 1% to return 15.9%. This is the complete sequence. The channel sets the direction. Break of structure plus fair value gap is the alert, and the fair value gap provides the entry location. I use 2 different entry points within the fair value gap depending on conditions. Option 1 is the 50% of the fair value gap. This is more of an aggressive entry, usually gives me a tighter stop placement, which equals a larger risk to reward. Just slightly though, marginal. Option 2 is use the 25%. It's an easier trigger, hits a lot more frequently, similar stop placement, just a little less reward. Not by much though. I don't pre-decide which I'm using. I look at what the market gives me. The moment of retest, I decide which is best, either the 25 or the 50%. A couple of things to note. You don't have to take every single setup. That doesn't teach you a thing. If you are doubtful of the entry, let it go and wait for the next opportunity. Trading more doesn't make you a better trader in the beginning. Wait, be patient, and take the entry only if it meets all your requirements. The better lesson here is learned when you sit and allow the trade to unfold without you being in the market. It confirms the process through the mind over and over and over and allows you to get used to the process. Far too often traders enter trading and all they want to do is make money without perfecting the process first. And that's where a lot of traders come unstuck, right? They really battle with, they think that trading is this P&L, but it's not. It's a bunch of processes that you have to become comfortable with, and so comfortable that you have to see them play out hundreds of times before you actually feel that comfort of the market and taking your opportunities live. This is an entry model, not a strategy. We use this in conjunction with a valid, profitable strategy, not by itself. Spend the next few weeks getting accustomed to this entry model. So when we go through the strategies, you will know the entry model inside out. Episode 7 is risk management, position sizing, stop placement, and the rules that protect your account before any entry. I'll see you then. Ciao.